Hi, I'm Anna from CoW. Wait 1 second. Perfect, now we have the right slide. And today we're here to talk about AMM designs, why they're currently broken, how we can fix them, and what other positive side effects it will have if we fix AMMs. Who here is currently depositing liquidity on Uniswap? Yeah. You might find out, and I think in the previous talk we actually had the question, who of you is hedging against LVR? And not so many people were raising their hands. So we are here to talk about today to let you know why you should rethink about how you want to provide liquidity in the future. So let's start. Why do we want to change the system? It seems to be working fine. AMMs have been around for a few years at this point. They have a ton of liquidity, so they seem to be okay. However, research has shown in the last couple of years that actually liquidity pools leak a lot of value. And this phenomenon we are calling loss-versus-rebalancing, or in short, LVR or LVR. And it essentially describes this adverse selection risk that you take by potentially taking the wrong side of a trade. So in traditional finance, this happens if you trade against an informed trader. But on blockchain, this problem is accelerated. It essentially happens on every single block. And so you basically are guaranteed to trade at an information disadvantage. So I don't call it adverse selection risk. I call it adverse selection guarantee. And to describe it with help of an example, today most of the price finding, unfortunately, is still taking place on centralized exchanges. So if you see that the ETH price is dropping from $3,100 to $3,000, then you can now go to Binance and buy 1 ETH for $3,000. On Uniswap, the pool will still show you the outdated price. So you can sell your 1 ETH for $3,100. So the arbitrageur is making a $100 profit, and then the liquidity providers on Uniswap, they sell at a loss. You can measure this loss by looking at how your liquidity position is performing compared to a rebalancing portfolio. If we look at concrete numbers, research, or basically what we can see is that there's a lower bound of at least 30% of the volume that has been settled on Uniswap v2 post-merge is coming from arbitrageur traders. So arbitrageur volume isn't equal your LVR loss, but you can be assured that arbitrageurs will only trade if they can make a profit. If you look at concrete numbers, research suggests that between 5 to 7% of liquidity providers' liquidity is lost annually due to LVR. This equals in US dollar an estimated amount, lower bound of $500 million. And this is on Ethereum alone. And from everybody who was raising their hands that they are providing liquidity to Uniswap, part of this money is coming from you. So in other words, providing liquidity on chain currently is not the happiest thing for liquidity providers. So we need to look into how we can solve this problem. How can we solve LVR? And in order to understand how we can solve it, we first need to also understand how the current systems are operating. So if we look at the traditional AMM market, most of the AMMs are using some type of constant function AMM. The reason is that essentially on blockchain currently, you have a lot of different transactions in a single block, and then they get executed sequentially. So you are first, second, third, or wherever in the block. One trade gets executed after the other. However, you get different prices, right? Like the first trader might get a different price than the second trade. So now this turns out to be a bit problematic because at the same time you also want to then fulfill to satisfy path independence, which means that there shouldn't be an incentive for you to split up your trade. If you trade $1,000 worth of a token, there shouldn't be an incentive for you to instead settle 10 trades of $100 each. Or maybe to have like a very simple way of describing it, on the constant function, your price is determined deterministically, whereas the actual price might be somewhere outside. So you basically have these two constraints on traditional AMMs, right? That you're processing trades sequentially and that you have to fulfill path independence. Now, we were going back to the drawing board and like see, is there like a different way of how we can actually fulfill this or make this less problematic? So we looked into batching as a solution. And if you collect all the transactions of a block into a single batch, and you execute them actually at a uniform clearing price, then the order of the transactions doesn't matter anymore because anyway, all of the transactions within this batch receive the same clearing price. And then it also doesn't matter anymore if users want to split their trades into multiple because in any case, the batch is re-aggregating all those trades. So as I mentioned, I'm from CoW, and CoW has been looking into batch auction mechanisms for a long time. So we have a live mechanism for over 3 years. And so we decided, okay, let's try it out. Let's build an AMM on top of this existing batching mechanism. So really brief overview of how it works. Our transactions are collected in a batch over a certain period of time. And then there's an auction where multiple external parties, who we call solvers, are competing to finding the best possible price for the orders that are in this batch. And they also have to comply to some rules. One is this uniform clearing price. Essentially, all traders with the same assets should get the same execution price. And then there's another criterion, EBBO, that requires that also the minimum price met is at least equal or better to existing other on-chain prices. Having this competition guarantees then that even if somebody is trying like to take advantage of of a price discrepancy, there's an auction, there's this competition between different parties who will all drive the price up. And then lastly, there's this consolidation of all transactions in the batch. You can net them out against each other, and only the leftover amount is executed then against the AMM. And by having this additional noises of like additional transactions, you can generate additional surplus that is then all distributed. This captured LVR and the additional surplus that is captured is distributed to the liquidity providers. So in other words, the LVR is captured and redistributed. In this way, the AMM doesn't suffer from it. Just to show you briefly how the price functions differ, on the left you have the constant function one of the traditional AMMs that is sort of like deterministically defining where your trade gets executed. And then now with the new approach, by batching, you can now think of a price function where the actual price point sits outside. So with every trade that you execute, you can move up this price function. This is why we are calling it function maximizing AMM. And looking concretely into the return of your investment, on the traditional AMM, it is sort of like a rebalancing strategy, just that you have the loss that LVR incurs, and then on top as a bonus, you get the fees that the AMM collects. On our new approach, the function maximizing AMM, it also operates in a way like a rebalancing strategy, but you do not incur the loss from loss-versus-rebalancing, and on top of that, you get additional surplus. So, in other words, batching combined with this new price function removes LVR and can finally make liquidity providers happy. This sounds great in theory. How does it actually perform? So as I mentioned, we did do an implementation of top of CoW protocol, and we call it CoW AMM. It's been live for a little over 3 months, and it has around 20 million in TVL at the moment. It's deployed across Ethereum, Arbitrum, and Gnosis chain, and has essentially 29 pools that have more than 10K in TVL. The most interesting data point up front, it currently outperforms Uniswap v2 pools in 50% of the cases. You might wonder, why do we compare against Uniswap v2? The reason is that Uniswap v2 is currently performing best for passive liquidity providers. So we wanted to compare CoW AMM against whoever is performing the best. Let's look into the methodology we're using. We looked into growth of 10K. So essentially, if you deposit $10,000 US into a pool on CoW AMM versus the equivalent Uni v2 pool at the same moment in time, how does the strategy perform? And the reason why we like this methodology is because it can be negative. Because at the end of the day, as a liquidity provider, what you care about is the total assets that you hold in your balance, in your wallet. We also look at APR comparisons, just because this is what users like to see. They're really used to it. But in a way, it's somewhat misleading because it can be very positive. You can sometimes have moments where it shows, oh, amazing, I have 100%, 200% APR. But it doesn't tell you so much. We use it for essentially like short-term price volatility. Okay, let's look concretely at the pools. The interesting part here is, I already said that CoW AMM outperforms Uni v2 pools in 50% of the cases. But the interesting part here is we also looked at TVL. And so Uniswap has larger TVL than CoW AMM across all the pools we compared. And the interesting component here is that in those cases where Uniswap TVL is only between 3 to 9 times higher than on CoW AMM, CoW AMM already outperforms Uniswap. And only on pools where the TVL of Uniswap is between 30 to 80 times higher, CoW AMM is still underperforming. And this is kind of expected, because the more TVL you have, the more over proportionally, it also attracts trading volume, so it will also generate more fees. So we should expect that as TVL is growing on CoW AMM, so should also increase its performance. Then we were actually curious to see if there's currently surplus left on the tables, because we literally, CoW AMM was just launched 3 months ago, and it also, of course, relies on good solver support. And unfortunately, so far, only 3 solvers integrated CoW AMM natively. So we looked into a token pair USDC West pool and looked at different performance periods. I think this one particularly shows for 1 week, or a little longer, actually. And looked into how many trades could have been settled against CoW AMM, but didn't, and what is the surplus that was left on the table. And it turns out that, unfortunately, 96% of the surplus is still not captured. And then we rerun the analysis across different time periods and also across different token pools, and it turns out that this captured 4% is even an upper bound. So sometimes even more surplus is left on the table. So we're currently working together with solvers that do natively integrate CoW AMM, because then also the performance will significantly go up. Loss-Versus-Rebalancing, LVR, is particularly problematic in times of high volatility, right? Like the more there's a price discrepancy between a centralized exchange compared to a DEX, the more value can be extracted. So we looked into those high volatile times, and there's actually a bunch of examples. I'm only going to show 2 now that are both pretty recent. So the SAFE token got listed on Upbit, and within a time span of 15 minutes, it had a huge price increase of over 80%. So we looked into this time interval, and there was a bunch of rebalancing transactions on CoW AMM. A bunch of them were juicy. One particularly juicy one generated over 10% in surplus. If you compare this with how it would have performed on Uniswap, there, to remind you, how does Uniswap capture LVR? Not at all. The only thing they have to kind of circumvent the losses of LVR is by taking a fee, but the fee is fixed. And the fee is fixed to 0.3%, at least on the equivalent pool. And so if you compare the profitability, CoW AMM essentially did 30 times better than Uniswap. Then, to give one second example, just to show this is not a rare occasion, last week the CoW token got listed on Binance, also led to a really big price jump. And there, essentially, even 15% surplus was captured in one single transaction. Again, price jumps, like the price movement obviously happened over a time interval of a few minutes, not in one single block. So there's a bunch of like individual rebalancing transactions on CoW AMM. And I just picked here one particularly juicy one. And again, if you compare this to a 0.3% fee on Uniswap, then on this particular trade, CoW AMM outperformed Uniswap by 50 times. So what's the lesson here? That's essentially if we remove LVR and we add surplus into the mix, we can actually really maximize the returns for liquidity providers. Now, if we remove the problem of LVR, we can finally also think of CoW AMM as an investment strategy. Why is this the case? It's because, in a way, it is performing like an index fund because it automatically rebalances. The reason why Uniswap wouldn't work as a good index fund strategy or rebalancing strategy is, again, because you have the loss due to LVR, which is now fixed. And then it essentially even outperforms an index fund because instead of having to pay fees to pool managers that are doing the rebalancing for you, it does it automatically. And then on top of that, so you don't have to pay fees, and on top of that, you even gain additional fees from the surplus. We call this new product DTFs, or decentralized traded funds. And it has all the financial upsides that I just mentioned. And it can also already support multi-tokens, because you can just create 2 different pools with like a 50-50 or 80-20 weight, and then you can take those newly created IP tokens and put them in a new pool. And this way you can already create your multi-token asset pool. We will also build on top of Balancer v3, so then there's going to be a more native, more straightforward integration of multi-tokens, but you can already do it today. And you have full control over your assets, naturally, and can access them anytime. And then there's this last really, really nice benefit also that comes from integrating on top of CoW protocol, which is that you can actually leverage your yield-bearing tokens. Because if you look at the Uniswap pools, they're all against WAS, right? But a lot of people want to hold wrapped stake ETH, SDAI, whatever, any interest-bearing token. And you can use them and put them into an AMM. One, because you have this really nice rebalancing strategy, but the highlight of CoW protocol is that its underlying solver mechanism can easily swap in and out to this token. So if somebody is interested in buying WAS and not wrapped stake ETH, they can still take advantage of the liquidity that's in the pool that you created. So instead of keeping all your idle assets, all your idle yield-bearing tokens in just your wallet, you can now think about, hey, why don't I deposit them in an AMM and earn additional yield on top? So rebalancing on CoW AMM, plus generating surplus, and leveraging interest-bearing tokens is essentially a little bit like providing liquidity on LSD. The summary is, by removing, so LVR today is the reason why liquidity provision doesn't work well. We can fix this now with a function maximizing AMM. And the current implementation of it, CoW AMM, is already outperforming UniV2 in 50% of the cases. And the performance will increase as there's going to be more server support and as the TVA will grow. And as of today, dysfunction maximizing AMMs can already unlock the potential of passive investment strategies. So I'm inviting you to try it out. Thank you.
Thank you, Anna. I am definitely interested to try it out. So let's take some questions. First one, if CoW AMM volumes come from the leftover of the batch, meaning that the noise trader volumes don't hit the AMM, aren't LP getting very little trading fees due to low volumes? And how do you solve that?
I would say that at the moment, yes, probably if you compare the fees, obviously that they receive compared to Uniswap volume, it's lower. But the real benefit is, so essentially there's studies showing that the fees that Uniswap v3 is making are not making up for the losses that LVR is creating. So just by comparing this, CoW AMM is already performing better, right? Because CoW AMM is removing LVR by pushing the prices to the real price where the price should be. And then even if the surplus is might be slightly lower than the fees, the surplus is on top of this LVR removal. And on Uniswap, it's only trying to make up for the LVR.
All right, next question. How much of the CoW operation happens on off-chain?
Well, they're basically we are working on a decentralization white paper because the goal is in the future to have everything fully on chain. But the matchmaking currently is taking place off chain.
Okay. Right, so the next one, if it outperforms UniV2 on 50% of the trades, what happened for the 50% remaining? Does it perform the same or worse?
I think I showed actually the performance on the slide, and it's currently performing worse. But it's like by 0 point something percent. It depends on the pool, depends on how much TVL it has, and it depends on how much volume we are able to capture on those pools. So there's no, this is the fixed percentage across the pools, but yeah, it is slightly underperforming at the moment.
Okay. Does CoW LPing work similar to Uniswap v3?
No, because Uniswap v3 is leveraging concentrated liquidity, and this is not the audience we are targeting. We are targeting passive liquidity providers. Actually, if you look in the performance of UniV3, everybody who's like trying to do passive, like who's not super active and is not an informed trader and like a specialist and knows what they're doing, are actually suffering even worse. Like their positioning return is much worse than on UniV2. So our target group is the passive liquidity provider who wants to get a return on their investment and not leak value. And so it's different.
Definitely. How can you come up with lower bound on percentage of swaps that are arbitrage?
Let me try to understand the question. How you come up with lower bound of percentage of swaps that are arbitrage? Do you mean I assume that is what is meant is essentially the slide where I showed this. So this is not research that we did internally. But there's a bunch of research papers that I think are quoted in the source of the presentation. So if you're interested, you can look into it.
Okay. Okay, so the next one would be, in the example you gave, CoW AMM outperforms UniV2 in 50%. Okay, that has been answered. So we're going to the second one. Can you call it an index fund when the token holding strongly depends on the price? Isn't hedging strictly necessary?
So as if you, like basically, if you look at an ETF strategy, what you do is you invest into it, right? And then you have like a company who's doing rebalancing for you. Actually, much less frequently than it happens on an AMM. So, depend on the price. So, in other words, for this particular, like, if you're like an informed trader who's providing concentrated liquidity on UniV3, then probably you also do hedging. If you're a normal passive liquidity provider who essentially just wants to earn some interest on their hard-earned tokens without being a professional at what they're doing, then no, you don't need it because overall you're not losing money, but you're making money on top.
Okay, so we have time for one last question. Do CoW AMM LPs outperform the HODL strategy?
Yes, we did look into it, and so the problem is we only have data periods of 3 months, but the short answer is yes, it outperforms it. Maybe if you look at like if a newly created pool was just set up and it's a couple of days old, then maybe there might be cases where it doesn't outperform it, but over time, yes, it does.
Okay, thank you very much, Anna. Thank you.